Hi friends, welcome to my show. Today I am going to cover one very important topic, how to secure your retirement. As you know, in India there are two main instruments, NPS and PPF. Which is better? There's a shocking factor. In India, a shocking 80% of people risk running out of retirement savings, turning golden years into financial struggles. Imagine this: 35-year-old executive like Raj earning 15 lakh annually, but retiring broke due to poor planning. Busting the myth, PPF isn't always safer. Many people think PPF is safe, but consider this: NPS equity has averaged 12 to 15% return since 2010, far outpacing PPF's 7.1%. See, this safe choice, what you think, costs you over 1 crore in wealth. Recent 2025 NPS changes also. This annuity to 20% means you get 80% in hand. Choosing wrong could lose you 40,000 plus yearly. Fear running out at 70 with healthcare inflating at 11.5%. If you are so investing in PPF blindly, you are missing out. Even advisors here. Be careful. By video end, you will know what fits you, how to plan your retirement, and secure your golden years. Understanding the retirement crisis. India's retirement landscape is very dire. 80% may deplete savings post retirement, with only 43% having contingency plans. Average life expectancy, now is 73 years, meaning 20 to 30 years post retirement. Inflation erodes savings generally at 4%. Healthcare, however, costs are going up at 11.5%. Living costs increase by 5 to 6%. How much is needed? Don't go by blind belief that 1 crore is sufficient. You have to have an inflation adjusted. Aim for 5 to 7 crores. Calculate what is your current expenses, say 6 lakhs per year, and 1% over the inflation, which works out with 4% withdrawal. You have to start early. This is the golden rule to enjoy the compounding effect. 10,000 per month at 10% from 30 yields, 2 crore in 30 years. Whereas if you start at 40, you get just 70 lakhs. Top mistakes is ignoring inflation, over relying on EPF, skipping tax efficient tools. But here is where it gets interesting. Just watch. Both NPS PPF are government backed, but NPS offers 40% more via markets. Tax savings, NPS extra 50,000 deduction, saving 15,000 in 30% bracket. Let's compare. NPS deep dive, which is essential. The complete picture is NPS is a market linked pension scheme, government regulated, contribute to funds managed professionally in equity up to 75% at G6, and for ages 18 to 70. You can go in equity up to 75%. So tier 1, which is the most popular, it is locked till funds are locked till 60. The tax advantages are there. Tier 2 without tax advantages is flexible, like investing in mutual fund. Returns 2010 to 2026, equity got you 12 to 15%, balanced funds got you 10 to 12%. Example of 5,000 per month invested, 25 years at 10% gives you 50 lakhs. Taxes 1.5 lakhs ETC, 50,000 ATC CD 1B plus employer 14% ATC CD 2 up to 2 lakhs in deduction. Withdrawal at 60 has been increased to 80%, which is tax free, 20% annuity, and partial withdrawal allowed after 3 years. Pros are high returns, best taxes, flexibility. The cons are market risk, some lock in, low annuity rates, 5 to 6%. Now let us talk about the safe option, PPF. PPF's guaranteed returns sound good, but they tag lag inflation. For 1.5 lakhs over 30 years, NPS builds 2.8 crore versus PPF's 1.4 crore at current rates. PPF deep dive the reality check. PPF is a government savings with fixed rate, tax free. Current rate is 7.1% for the first quarter of 2026. If you invest 500 to 1.5 lakhs a year, 15-year lock extendable, and returns are 2010 to 2026 average 7.5%. Example, if you put 1.5 lakhs for 15 years gives you 40 lakhs. But real return, look at the real return, which is just 1% over the post inflation. Is it really worth it? Taxes, 1.5 lakhs deduction, of course, it's on EEE exempt status. Withdrawal partially allowed after 7 years. Loans are available in years 3 to 6. The pros, advantages or pros, what you call zero risk, tax free, liquid. Cons are low returns, capital long lock, no flexibility. Here is the million rupee question. Which builds more? Numbers reveal, they don't lie. Let's compare. Head to head comparison. Assume a 30-year-old with a 10 lakh income investing 12,500 per month till his 60th year. That's a 30-year investment. NPS at 10% gives you 2.8 crore, 80% withdrawable, so 2.2 crore in hand and 20% annuity, that's about 56 lakhs. It gives you a pension of 25 to 30,000 per month. Whereas come to PPF, what it gives at 1.5 lakhs per annum, you get just 1.4 crore. A gap of 1.4 crore, friends, is a big money. Don't lose it. Inflation at 6%, NPS power 49 lakhs as of today, whereas PPF is just 24 lakhs current day's worth, considering inflation. NPS, what to do? So NPS, I would say, is suitable for less than 45, moderate risk, maximum growth and high tax. PPF for 50 plus, zero risk, safety. However, hybrid is more reliable. 70% NPS, 30% PPF. It has to be rebalanced. But wait, there's a catch. NPS is not all that rosy what it appears. 20% annuity is uncontrollable at a low rate of 5 to 6%. Let's nuance. The nuance is what they don't tell you is NPS issues annuity 20% yields are low and 56 lakhs gives you 25,000 per month. And it's not inheritable. Monitor fund managers and limited withdrawals. Whereas coming to the PPF bonuses or loans and partial penalty free, full inheritance, and rates adjust up in inflation whenever the government decides. What the advisors normally advise is 60 to 70% you put in NPS, 30 to 40% PPF, shift to PPF post 50. So, what should you do? How to plan your retirement? I will give you an easy methodology. Use these three question test. Your personalized decision framework is here. First question, how many years you have to retire? If you have 25 plus years, put 80% in NPS, 20% in PPF, this might take. And if you are 15 to 25 years to retire, put 60 40, 10 to 15 years, 40 60, less than 10 years, then you should go for PPF because you cannot take a risk. Because NPS gives you yield over the years. Okay. Second question is, are you in a position to handle a 20% drop? If yes, go for NPS. If no, then go for PPF. Question 3 is, do you have an emergency fund to manage backup? Yes, then go for NPS. No, then do PPF first. My take is 30s NPS aggressive, say 10,000 per month, and PPF 2,000. If you are in 40s, balance split 8K, 4K. In 50s, mostly you do PPF. However, avoid single option. Default allocations, no reviews, early pulls is very, very bad for retirement planning. Conclusion is your retirement action plan takeaway is one, NPS for returns 2.8 crore. Remember this, 2.8 crore versus 1.4 crore. PPF for safety, blend age based. That's the key for successful retirement planning. Start now, don't delay. Consistently you do for the 20 to 30 years. Now you have the facts. Decide wisely. Thanks for securing your retirement. Thank you and bye bye.